This is Chapter 9, Video 3. Let's launch. Okay, so in this video, what we're going to do is we're going to describe the accounting periods available to businesses. Now, this is going to be a little bit of a long video. I want you to stick with me, though, and we'll try to get past this as fast as we can. So accounting for taxable income, so we've already talked about in previous slides about gross income and deductible expenses. Now we have to match the income and deductions to the specific period, and that's really important because one of the biggest problems that I think we talk about in some of these other areas is when we talk about business timing of deductions. Obviously, the fact the expense happens, but we have this sort of artificial, construct called the calendar. And I say artificial because it's based on, the movement of the earth around the sun. But let's be honest, business doesn't really care as much about the movement of the earth around the sun as much as it just happens. And we have an artificial cutoff as a result of that. But you need to make sure that it shows up in the right period. And so the IRS has given a lot of guidance in how a lot of this goes. And obviously we need to follow it in order to get our clients the appropriate tax treatment. But there's also some stuff that you can do to really help your clients out. Just a little quick war story on this. I had a client who came to me, and basically what had happened is that he had sold some supplies he was an exporter, and he sold supplies overseas, but he had received about, I think it was like 70% of the cash up front. But the goods hadn't been delivered yet. And so he was a little bit concerned that, he was going to be like, well, yeah, I got all this cash. It's all great and wonderful, but I don't want to pay taxes till later on if I don't have to. And so what ended up happening is we were able to do something for him that allowed him to be able to defer that income to the following year because, and one of the concerns that I personally had with this is that the income was subject to a recapture provision. So if these goods were not allowed outside the United States for whatever reason, and actually COVID did have an impact on him, but if they weren't allowed outside of the country, he was going to have to give this money back, which of course he was not looking forward to doing. And and I was kind of like, well, I don't want you to pay a whole bunch of tax just to find out later on that you shouldn't get that. So we went ahead and we actually found a couple ways to be able to get this done, and this is kind of where we found some of that information. Okay, so accounting periods, you're going to have a full period. Obviously, it's 12 months long. Short periods is going to be less than 12 months, and you'll have a short period for a number of reasons. Some of the reasons why we'll have the short period is going to be because they just started the business or the business ended. You can also have with partnerships what's called a tech term, which is a technical termination. That could happen. Say, for example, you've got a 60-30-10 partnership, and partner number one, who's got the 60%, decides, hey, guys, it's been fun, but ain't been real fun. Yeah, I'm gone. And he decides to take his stuff and go home. What ends up happening is you could have a tech term, which basically means you got to stop it at that point, and then you have to restart the partnership because you still have 30 and 10 still around, and that's going to probably delineate to where it's going to drop to a 75-25 relationship as a result of that, unless they swap out for another partner. That could actually have a where they could change. It could actually cause some interesting things. But that's what's going to end up happening. You'll probably not have to deal with this very often. I mean, I've been doing this 20 years. I've only had once that I've had to deal with something like this. And luckily, facts and circumstance actually allowed us to avoid the tech term because they came to us ahead of time, said, major partner's going to leave. What can we do to avoid the tech term? And we were able to help them get around that. And that was very useful. So the year ends. If it's a calendar year, it's going to be 12/31. If it's a fiscal year, it's going to be dependent upon choice. Now, it says choice. I want to be very careful about saying choice. There's actually rules that prevent you from choosing a lot of the stuff. And, especially in the area of partnerships. So say, for example, you have a partnership where the corporation is one partner, and say they're a 60% partner, and they have a fiscal year end, and we'll say 4/30. And then you have the rest of the partners that are 40% or less, and they're all calendar year people. So what the IRS is going to say is that you have to follow a specific set of procedures to determine when the calendar year of the partnership is going to be. And what they're going to do is they're going to try to do maximum non-deferral. And I know that's kind of like, it's kind of like a lot of, conditional in that phrase, but they're not going to want you to defer income any more than necessary. So the fact that you've got a 60% partner that's got a fiscal year could cause a situation where you're going to have to consider filing on a fiscal year basis. All right. So when you choose the partnership accounting, when you choose an accounting period, proprietorships are going to be the same as proprietor's year. So if you got a Schedule C, your end of year is probably the same as the proprietor's end of year. And if they're individual, can't guarantee you, probably going to be calendar. Okay. So you're going to follow the calendar year as a result of that. Schedule C. Now here, actually, let's go back. Proprietorship. Does a proprietorship have to be owned simply by an individual? No, a corporation can also have a single member. What we call them disregarded. In the industry, we call them tax nothings. So you have an LLC that's owned by a corporation. The LLC has, does a lot of stuff that the corporation doesn't do. Actually, a very good example is Beta Solutions. We have an LLC that we own that does government contracting. We do government teachings through that LLC, and it's actually Beta Government Solutions. It is a tax nothing. It doesn't exist in terms of the IRS. It's actually part of our thing. I went ahead and we're going to actually make some elections in order to get that thing taken care of. But in theory, Beta Solutions owns a sole proprietorship. And if Beta Solutions had a different fiscal year, it could be different. But again, if it's an individual, probably going to be a calendar year. There's nothing you can do about that. C corporations and individuals made choices on the first tax return and is consistent with the accounting period. Now, there are certain times where the IRS is going to ask, you're going to have permission to have that fiscal year. And we'll talk a little bit about that as we get into the slides. But for the most part, if you have to have IRS permission, you're going to have to fill out what's called a 3115. And guys, if you thought doing tax returns might be painful, the 3115 is a long form. In fact, our firm, we charge a hefty price to get it done because there's a lot involved in order to get it finished. And so I try to avoid it whenever possible. But if we can say the client, I've had one that I did a 3115 on one of my clients. We ended up saving them, I believe it was about $30,000 in taxes, because they hadn't been taking depreciation properly over a 20-year period. It's a time where you can actually use it and really help your clients out, and it's a good deal. So again, you're going to fill those 3115s out if you want to change it. They do make it on the first tax return. It has to be logical. If the IRS disagrees with it, they can come back and make some stink about it. And of course, if that ends up happening, well, it's just extra fees for you, but it's also extra cost for your client. So we want to make sure that we choose correctly. Flow-through entities have a required tax year. Again, you must match the owner's period, multiple owners. This can be complicated, and I've already discussed that. So financial and accounting methods. So in reporting financial statements, they have incentives to select methods permissible under GAAP that accelerate income and defer deductions. Contrast tax planning, businesses have an incentive to choose ones that defer income and accelerate deductions. So the IRS doesn't want you playing games. If you're going to choose something for financial purposes, they're probably going to want you to choose it for tax purposes in as far as like tax and accounting methods. Now, obviously, the IRS is going to come back and say, well, under our laws, we want you, a very good example, depreciation. If I want to use some of the year's digits, in order to do depreciation, I can't use that for tax purposes. I have to use makers. And, depending upon what kind of an asset it is, if it's a... if it's a short-lived asset, under that's tangible personal property, might have to use double declining balance until I get halfway through and then straight line going forward. Or if I'm overseas, I might be forced to use straight line because in a foreign context, you're probably going to have to go under what's called the alternative depreciation system. Don't worry about that at this point. It's not covered in this video. We'll cover that later on. But that's where you can have a little bit of a problem with that. Again, whatever you're doing for financial, the IRS is pretty much going to want you to do for tax unless specifically delineated in a different rule. So permissible overall methods: cash, income recognized when received, accrual, recognize income when earned or received, whichever is first generally. And then you have a hybrid, which basically says, sales on accrual, mix of accrual and cash depending upon accounts. I'll be honest, 20 years, I've never done a hybrid. That doesn't mean they don't exist. They're actually, I have a friend of mine who actually does primarily corporate returns. And I've actually asked him about this in the past. And he said, yeah, he's done quite a few hybrids in the past. It can make sense. I mean, usually companies are going to go hybrid are, they're not big companies, because if you're too big, you have to go accrual. But if they're big enough that they can actually pay for really good tax advice and kind of get into the weeds with some of this stuff, they can do. So methods are adopted with the first return. Large corporations, must use accrual, and that's what we kind of talked about. Large corporations partnerships have to use accrual, and that's going to be on a gross income test. I remember I had a client that was right around that level every single year, and we would have to, kind of play with it to kind of see, did they have to go from cash to accrual because of this? And if that happens, you got to do a 3115. You got to calculate a code section 481 subsection A adjustment. And it could go negative for the client, could go positive for the client. It's not a fun deal, but when you have to do that, you've got to do it and you got to move on. Cash method, again, income is recognized when actually paid or constructively received. In other words, when you have the right to the money. So if the check's in the mail on December 31st and you haven't cashed a check by the end of the year, does that mean that you still recognize it? The answer is yes. You had a right to the money because it was there. You had it. You're going to have to recognize it. And cutoff testing, those of you who actually work in audit, cutoff testing is a major thing. But it's also a major thing in tax. The question is, you have this thing. Sometimes, when we worked on big tax return, usually a corporate, like very, very small corporation, we're kind of, yeah, whatever. We're not going to really pay too much attention to it. It's usually not something that gets asked significantly. But if I know that a client has a habit of not cashing checks frequently, sometimes I'll ask them, hey, what kind of checks did you have that you cashed right around this time? You can ask them for a copy of their bank statements that'll say what checks they cashed that time. And then you can kind of look at it and say, look, this check was written on December 21st. You obviously had it. You received it. Probably should be income in the previous year versus this year. And obviously with bigger bigger firms or bigger clients, they're going to have more sophisticated accountants who are actually going to be keeping track of this a little bit better. It's a little harder with the smaller clients, because sometimes smaller clients, they're not that sophisticated. Sometimes it's a one-man show, and as a result of which you have to kind of play with that game as it is. Pros and cons, it's flexible, simple. Poor matching of income and expense. I agree with that from an accounting perspective, but I recognize income when I got cash. If I got cash is going to allow us to be able to, cash is king. If I have cash to be able to pay off expenses, that's going to be a good thing. When I actually cut checks in order to do expenses, that's going to be a big thing. So, it can be used by taxpayers to satisfy the gross receipts test, as we've talked a little bit in the past. Accrual income, it's, this basically, if you're in accounting 351 class and you don't know how accrual works, got some issues. Okay. So I'm not going to talk too much about this. But they do say, earliest of these dates, completed service sale, payment is due, payment is received. So in my client's case that I talked about earlier, where he had actually got the money ahead of time, technically should have been income recognized immediately under any of these. But because of some IRS rules, we were able to defer that for a year, which is good because, the transaction was complete this year. And so the chance of him losing his money is almost zilch. So an accrual question, Ben provides consulting services and bills ACE for $12,000. So accrual question, Ben provides consulting services, ACE bills for $12,000. ACE disputes it and reclaims that $8,000 is the proper amount. How much do they recognize under the accrual method? I'm going to tell you this is a very common question. My personal opinion is if it's still in dispute by the time you're filing it, we're going to go ahead and we're going to recognize that we're probably going to recognize the $8,000 amount. And that's the way that I would do it at this point. If the dispute is legit. Now, like I said, if it's not figured out by the time you file the tax returns, that's where it gets kind of wonky, because here's the thing. I prepare tax returns for people. People come back to me, whoa. I thought it was going to be this. Can you charge me this fee? We go back and forth. Sometimes I say, yes, we can. Sometimes I'm like, I can't look at this. I can't do this. You've got to pay what we told you to pay. And if that ends up happening, you've got to kind of make a call at that point based upon the accrual rules. I would say, you would do the 8,000. But of course it's going to be dependent upon, like I said, if they make the dispute in January, by February, it's resolved and ACE goes ahead and pays the $12,000 because they kind of go, okay, we disputed it. We thought we were right. Sorry, we're wrong. Give me a culpa. Here's my 12 grand. Then you're going to recognize 12,000. That's just the way it is. But if there's a dispute at that time and they're refusing to pay anything more than 8, you're going to recognize the 8 because that's what's the case at that time. So accrual prepayments so advance payment services, you can defer recognition for 1 year unless income is earned or recognized for financial records. In the case of my client, we didn't recognize it. We did as prepaid income. So what happened is that we did it as it was basically a cash received, deferred income, or not deferred income, but prepaid income. So it was done as a liability. So for financial purposes, he was in the clear. So that was actually good. It's not acceptable payments relating to rent or interest income. That is obviously not the case with my client, and that's how that worked out. Advanced payment example. Ben provides dancing lessons on September 30th of the year. He received $2,400 full payment for a 2-year service contract. What amount of income must Ben recognize? If he's on the cash method, got to recognize it all. He's got cash. Cash is king. He got it. It's do re mi, emphasis on me, and I am looking pretty good. So I got to recognize all that income. What if he's on the accrual method? Well, it's a 2-year service contract. Can I defer for a year? And the answer is, well, according to the previous slide, we could. But I'm kind of the mindset that even on the accrual method, he may be forced to recognize this because it's going to be longer than the 1 year. So he might be able to defer it on a year, but we'll see. So if you use the cash method, got to do it. Like we said, accrual method, you can elect to defer services for the year. Would recognize $300 on it. Yeah, and that's what I was saying. So he's got to recognize $300, but but again, you've got to elect to do the deferral. My personal opinion is I like the way the book did this. Now that I'm thinking about it, I think it's actually better, but, you got to be careful with this sort of stuff. So luckily you're not going to run into this very often, to be honest, but anyways, it is what it is. So inventories have to be accounted under the accrual method if sales of goods constitute an income producing factor. So, what does this mean? Basically means that what you're going to do is you're going to use a perpetual or a periodic inventory method, which you've discussed under regular traditional accounting. But they're going to say they have to be accounted for under the accrual method if the sales constitute an income producing factor. So sales and purchases must be recorded using the accrual method. Hybrid applies to cash basis taxpayers with inventory who use accrual for sales and purchases. So again, if you're cash basis, but you're forced to use the accrual method for this, that's a hybrid. You kind of go on and that's how that works out. Unicap. Okay. So Unicap is where we're kind of talking about universal capitalization. Inventory must be accounted for using the tax version of full absorption rules. Indirect costs are allocated to the inventories. Costs of selling and advertising need not be capitalized. Exception for businesses that qualify under the gross income test. I'm not going to go too much into this. My thought is, the slide kind of describes what it is, and we're getting kind of short on time. Inventory flow exception. So for FIFO is kind of the default there generally. Most people are going to use FIFO. You'll probably, when you did your financial accounting, you probably studied about how Ford used to do LIFO. And I'm going to tell you though, the IRS they really hate LIFO. They really hate LIFO, and there's a lot of limitations on using LIFO. So it's the same as if you use LIFO for your financial statements, you can use LIFO for your tax. It will generate lowest taxable income in time of inflation. Book tax conformity requirements do exist though that you have to do. And then of course you could also use specific identification. I think as technology gets better, specific ident is going to be actually the best way to go. Accrual business expenses, all events test. If you have all the events to occur to establish a liability to pay, you can accrue it. The amount is determinable with reasonable accuracy, and then reserves for future liabilities is not allowed. So, for example, actually, I'm not going to use an example. That's pretty self-explanatory. Economic performance test has to have occurred. Okay, economic performance applies to accrual method taxpayers only. So they provide goods and services. Again, taxpayers using property or goods. Performance occurs as goods are provided or economics performance is otherwise expected within 3.5 months of payment. Why 3.5 months? What happens 3.5 months after the end of the year? That's when your corporate tax returns are due. That's why they give you 3.5 months. So if you have a corporate tax return and you do that 3.5 months, you got to take that into consideration. That's usually why the IRS likes to use that. So payment liabilities are performed only when paid, and rent and interest do occur ratably. So if I have a situation where I go, okay, I'm going to prepay rent for 2 years, I get to take the deduction off of that over time as opposed to all at once because of the rules under that. Liability and economic performance. You have to capitalize if there's a 12-month rule that's in place. So, for example, if I buy something, say I buy like I'm going to go out and I'm going to buy a service contract. And with that service contract, it's going to be a 2-year period. I have to capitalize. I have to expense that over time as opposed to when I actually paid the cash. Okay, so that's when we're going to be able to do it. Now, deductions are allowed, but again, you're going to have to follow the rules under IRC 461, and they're going to actually, and I want you to know, actually in 2012 when I first started, 2011, 2012 when I first started in the CPA world, this was the big topic. This was the huge topic, and we all had to kind of deal with this. And I remember attending a lot of CPE on this. In fact, it was when I first got in, I had no clue what I was doing. I was watching all this stuff, and I'm kind of like, yep, got it. And I had just left the military, and most of the time, military CPE training is basically, we do it just so that we can show we do it as opposed to actually learning something from it. This is where I was glad that I wasn't playing that game anymore because I did learn quite a bit off of it. Now, that was off of the temporary regulations. And of course, temporary regs, there was a lot of things that ended up changing after that. But it's still an area that I think that is not. The IRS has been grasping with this for years, and they've been struggling with it. And I think over time they're finally going to get this done right, but it's going to take a long time because the problem is there's no hard and fast rule. It's all facts and circumstances, and it's very difficult to create a hard and fast rule for a mechanical test of when to capitalize and when not to. All right, due to time, I'm going to go ahead and skip the example. If you want to look at it, you can do that on your own. Look at my smiley face. All right, and then this is the solution. Again, smiley face. All right, so choosing or changing a method. Methods are generally adopted by use. So the permissible method is adopted by using and reporting it for 1 year. An impermissible method is adopted by using or reporting the method for 2 years. Now, some of you might say, well, wait a minute, hold on a second. So I can do something the IRS doesn't want me to do, but if I do it for 2 years, I have to do it going forward? The answer to that is yes. If you do an impermissible method, you file your tax returns and nobody stops you from doing it, you want to change from impermissible to permissible, you have to do a change of accounting form, and that's 3115. Okay. Some changes are going to be, like I said, it says there, generally method changes require IRS permission. Some are automatic. Very good, very good example. I have clients who oftentimes they set up the rental business because they're basically saying, hey, I want to rent out property. And then they don't do depreciation because somebody at a blooming cocktail party told them, oh, if you do depreciation, you have to recapture and pay taxes on it. Well, what they don't tell you is that the IRS says, and we'll talk about this in chapter 11, but, if you don't do, or, if you do the, it's depreciation that you took or could have taken, and that's exactly what it is. And so, so that's kind of thing. If you want to go from an impermissible method to a permissible like that, you can do that, and it's an automatic change. Usually you file the form. I don't know what the IRS does with them. For all I know, they go into a black hole. But you know, usually if it's permissible and it's automatic, there's nothing to really deal with. If it requires a little bit of thought, they'll actually come back to you and say, yes, we agree that you can do this. This makes sense. We agree. We understand why you're doing it, and it makes good sense. But the IRS could also come back and say, nope, we're not going to accept it. You did this. You're stuck with it. You're going to have to go with it. So permission is necessary to correct the use of an impermissible method. That is true, unless they have an automatic change. Okay. I mean, technically by sending off the form, you're asking for their permission, but if it's an automatic change, it's going to allow it to be sort of automatic at that point. All right, folks. So that's the end of this class. I told you to go a little long, and I'm sorry about it. I tried to blow through it as fast as I can. We're trucking along. I'm glad you're here, and I look forward to seeing you at the next class.